Hello everyone, my name is Jake and welcome to Growth Academy. If you're new, please consider subscribing for more content like this one. Let's get on with the video. Cathie Woord, the CEO and CIO of ARK Invest, has sold virtually all of her Chinese interests in recent weeks. This action effectively overturned ARK's February plan to acquire Chinese equities. On the contrary, many investors are seizing the purchasing chance. Charlie Munger, Warren Buffett's right-hand man, Ray Dalio, the CIO of the world's largest hedge fund, and Manish Prabhai. Everyone believes that Chinese stocks are currently trading at a significant discount. This begs the issue for investors: which side should we take? In this video, we will discuss all sides of the issue and bring the heated debate in Chinese stocks to a close. Cathie Woord discussed during the ARK Invest July market webinar how we've already witnessed a value reset in Chinese equities for a variety of reasons. The core of capitalism is that the desire to earn money leads to the creation of productivity and innovation, with China's new rules affecting thriving firms like Duddy, ANT, and Tencent. Cathie feels that the motivation for success has decreased in China, and as a result, she predicts that less innovation and development will occur in the long run. In addition to lesser incentives, many people assume Biden would be more forgiving on China than Trump. Yet so far, the Biden administration has been hard on China. A Chinese state-run media source recently accused Biden of threatening war. As a result of growing tensions between the United States and China, international firms may face stringent commercial constraints. For example, Alibaba is aggressively extending its AliExpress marketplace into Europe. However, if there are any security issues, this expansion may not take place as planned. Cathie sees this as a big impediment to future growth. The last reason ARK is exiting China is due to short-term value concerns. Cathie Woord frequently concentrates on long-term movements, but she also observes and actively trades short-term patterns. Cathie feels that values in Chinese equities will remain low for some time since there are no short-term regulatory triggers. As a result, Cathie Woord and ARK Invest may purchase back Chinese equities in the future. Cathie Woord is now banking on the short-term trends that stay-at-home services will continue to outperform expectations. As a consequence, she would prefer invest in this gamble than in Chinese assets, which are expected to stay cheap in the medium run. Many value investors, on the other hand, feel that the Chinese capital markets are now highly appealing. Most investors consider Warren Buffett to be the greatest investor of all time, and for good reason. He has a fantastic long-term track record. However, many investors contributed to Berkshire Hathaway becoming what it is today. Li Lu, the buffet of China, and Charlie Munger, Buffett's right-hand man, are two of such guys. Both of these renowned investors feel that Chinese assets are currently very cheap. Li Lu is a successful fund manager who, according to various sources, has averaged a 20% annual return since 1998. That is really amazing, and one of the major ways he has accomplished this is through investing in foreign investment opportunities, particularly in China. Li Lu was the one who persuaded Berkshire Hathaway to buy BYD Auto, a stock that has increased in value 59 times since Berkshire's original investment in 2008. Charlie Munger assigned 19% of the daily newspaper's portfolio to Alibaba, which was a highly unusual event. As previously stated, Munger only held 4 equities, with Alibaba now being his 5th, and because of how close they are, reports say that Li Lu persuaded Charlie Munger to acquire Alibaba's stock. Finally, Munger's investing thesis on Alibaba boils down to Alibaba's fundamentals and the CCP's incentives. The Chinese Communist Party has no motive to stifle Alibaba's expansion in China's major tech. As a result, Chinese regulations affecting China's big tech are unlikely to have a significant impact on the fundamentals of big tech. Munger is not usually like Buffett in that he is less concerned with what others think of him. In this scenario, he views Alibaba as a burgeoning e-commerce and cloud computing behemoth that will most likely continue to dominate. He is unconcerned about being labeled a sellout for investing in Alibaba. His Alibaba venture, on the other hand, is fraught with danger. Munger has spoken out against the variable interest entity (VIE) structure. which is the structure utilized by Chinese stocks to go public on the New York Stock Exchange in order to attract global investors. However, his concerns appear to have subsided because there is no reason for China to oppose the VIE structure, and any opposition to the VIE structure would either frighten away all international investors or instead plunge China into a severe recession or spark World War III. Like Munger, another well-known value investor, Monish Pabrai, is highly optimistic on Alibaba and has allocated more than 14% of his fund to the business. Over the course of 18 years, Monish Pabrai allegedly compounded a return of 25.7% each year. He accomplished this by seeking for stocks that had a significant margin of safety while still having the potential to 5 times in value rather than merely slightly discounted ones. In a recent interview, he claimed that Alibaba and Tencent are fundamentally sound, capitalistic firms that would continue to develop rapidly. We have some interesting arguments on both sides of the discussion. Cathie Woord may be creating a short-term strategy based on Chinese stock valuations being low for the time being. On the other side, she might be selling out China because the risks aren't quite worth it and future innovation will be lower than anticipated. From a basic standpoint, Chinese assets, in my opinion, are undervalued, especially given the majority of China's enterprises have stayed essentially unaltered. The vice chairman of China's Securities Regulatory Commission told U.S. bank executives recently that China will continue to enable Chinese firms to go public in the U.S. as long as listing conditions are satisfied. Furthermore, he went on to explain how China's regulatory body did not anticipate the market reacting so badly to China's new laws. In the future, he indicated that China will consider market reactions to new measures and will prevent extreme volatility. As you may know, China has previously stated that the whole education industry would become a non-profit sector. In the meeting, Fang addressed the move to outlaw for-profit education firms, calling it a one-time occurrence. Despite all of the seemingly positive news, there are still major dangers associated with investing in Chinese equities. We are all aware that further rules may be imposed on China's top corporations. Not only that, but World War III or the next Cold War might occur right before our eyes. Investing in Chinese equities might be a profitable financial move if you are satisfied with the risks and any ethical issues. At present values, China's top tech may rise in value by 2 to 5 times over the next 5 years. Let me know below if you think investing in the Chinese stock market is something for you. As always, if you enjoyed this video, please hit the like button and subscribe. And I'll see you in the next one.